Hello and welcome to our new Wilkins Southworth video. I'm Chris Wilkins. At Wilkins Southworth, we always explore the problem to ensure that you get the most proactive and best tax advice.
Caught in the net. Crypto holders under HMRC's microscope. Imagine checking your inbox to find a letter from HMRC questioning your cryptocurrency activities. You may have thought those small Bitcoin trades were below the radar, or that staking rewards wouldn't count. Well, HMRC's net has tightened, and they do count. Even modest transactions are now in the spotlight thanks to advanced digital tracking partnerships with crypto exchanges and new data sharing agreements. The growth of crypto and the tax blind spot. The surge in cryptocurrency popularity over the last decade caught governments worldwide off guard. Bitcoin, Ethereum and thousands of alternative coins moved from niche investments to mainstream portfolios almost overnight. Yet, in that rush, tax authorities, including HMRC, struggled to adapt, and many are still struggling. Initially, investors assumed that crypto assets operated in a regulatory grey area, decentralised by nature and often traded peer-to-peer. It felt like the Wild West of finance, but somehow outside of tax regulations. However, the tax reality was always lurking. In the UK, cryptocurrencies are considered property, and their gains or income are taxable. The lag in enforcement gave rise to a false sense of security. As crypto values soared, few individuals reported their gains out of confusion, oversight, or the mistaken belief that they didn't have to. Now, as HMRC catches up, many crypto users find themselves exposed to potential tax investigations, penalties, and charges. The new reality. HMRC's digital focus. Recent developments show HMRC is no longer behind the curve. Significant resources have been allocated to track digital assets more accurately, and the department's capabilities are expanding rapidly. First, HMRC has entered into data sharing agreements with major cryptocurrency exchanges such as Coinbase, Binance, and Kraken. They are now required to provide customer data to tax authorities under International Common Reporting Standards (CRS) agreements. This means trading activity, wallet addresses, and sometimes even balances are visible to investigators. There is nowhere to hide, even in a parallel, decentralized universe. Second, blockchain analysis tools have become far more sophisticated. While decentralized, blockchain is also public and immutable. With the right software, HMRC can trace wallet movements. This includes linking pseudonymous addresses to real-world identities and mapping networks of transactions. As many investors are now finding, a single slip, such as withdrawing crypto to a personal bank account, can unravel attempts at anonymity. Finally, the UK's approach aligns with broader global trends. Initiatives like OECD's Crypto Asset Reporting Framework, CARF, ensure that international cooperation will further reduce the places where undeclared crypto can hide. In short, assuming crypto trades are invisible to HMRC is now a very risky bet. What crypto transactions are taxable? Understanding what constitutes a taxable event in the crypto world is essential to staying compliant and is no different from more traditional assets. Many people mistakenly believe they only need to worry about tax when converting their holdings into pounds. Unfortunately, HMRC takes a much broader view, considering a wide range of transaction/activities taxable. Ignoring these rules could lead to significant underreporting and major penalties further down the line. Here are the main types of transactions you must consider. Selling crypto for fiat. Converting Bitcoin or any other token into pounds is a capital disposal event and must be reported. Trading between cryptos, exchanging Ethereum for Solana, for example, is treated as two transactions, disposing of one asset and acquiring another. Using crypto for purchases, buying goods or services with crypto counts as a disposal at the crypto market value. Gifting crypto. Gifts of cryptocurrency, excluding those to a spouse or civil partner, can create a taxable event based on market value at the time of the gift. Mining rewards. Income from mining activity is treated as trading income if undertaken commercially or as miscellaneous income otherwise. Staking and airdrops. Depending on the acquisition circumstances, staking rewards and certain airdrops can also generate taxable income. Each transaction type has its nuances, and the applicable tax, whether capital gains tax, CGT, or income tax, depends on how the crypto was obtained and the transaction context. As a rule of thumb, any time you dispose of or acquire cryptocurrency in a way that creates value, it's wise to assume there could be tax consequences. Keeping detailed records for each type of event will make your life easier when preparing your tax returns. Avoiding trouble, your to-do list. Navigating the complex world of crypto taxation might seem overwhelming at first. However, by approaching it systematically, you can reduce your risk and bring clarity to your financial records. Acting now will keep you on the right side of HMRC and give you peace of mind when you are fully compliant. Whether you are a casual investor or an active trader, here's a practical action plan to follow. Review your activity. Go through your complete transaction history, including trades, transfers, and any crypto-related income. Maintain detailed records. Keep records of dates, amounts, transaction types, exchange rates, and wallet addresses. Most exchanges allow you to export transaction histories, which can be a good starting point. Calculate gains and losses accurately. Use reputable crypto tax software or consult a tax advisor familiar with digital assets. Accurate valuations at the point of each transaction are critical. Declare on your tax return. If you owe tax, ensure you submit a self-assessment return, including the necessary crypto disclosures. Even if you're already filing, ensure crypto activity is reported correctly. Act early. HMRC has shown leniency to those who voluntarily disclose errors or omissions. Penalties are harsher if mistakes are discovered during an investigation. Seek professional advice. The tax treatment of crypto can be complex, especially with activities like DeFi, decentralized finance, NFT trading, or cross-border transactions. Don't hesitate to engage expert help. Taking the time to get organized now will make tax season far less stressful. It also positions you well should HMRC raise any questions in the future. The ability to produce clean, clear, and accurate records is often your best defense and could save you significant money and trouble. It also avoids guesswork or worst-case scenario situations being used to calculate any potential tax liabilities. Summary. Cryptocurrency might have started as a decentralized rebellion against traditional finance, but there's no escaping the rules when it comes to tax. HMRC's crackdown is real, growing, and data-driven. Ignoring it could be an expensive mistake. Even modest crypto holdings can trigger reporting obligations, and the cost of non-compliance can far exceed the effort needed to get it right. The good news is that with early action, proper advice, and solid record keeping, navigating crypto tax doesn't have to be daunting. Staying proactive today could prevent major headaches tomorrow. Crypto investors who understand their obligations, rather than hoping to fly under the radar, will be best prepared for the future. If you are concerned about changing regulations and how this may impact your tax liabilities, we can help clarify the situation. Simply visit our website and leave us a message. We will then get back to you as soon as possible. By the way, don't forget to subscribe to learn about other videos in this series.